So this is part number 30 of this multi-part video series. Part number 30, part number 29, I don't really remember, but this is the next video in this video series. And this is an old chart of Sera Sanitary Ware. You see May 2023. As per the Indian SEBI regulations, we can only discuss old stocks with old data. Okay. So let's look at Sera Sanitary Ware. The purpose of this video is to help you understand the importance of price and volume action and a little bit of trade management as well. Okay. And studying price movement after the stock has broken out. What are the clues to look for inside the base to determine whether it's a low risk or a high risk base? So have a look at this. This was termed as a flat base by MarketSmith. So as you know, I do not discuss how the base is formed or how to identify whether the base is cup with handle, cup without handle, double bottom, flat base, ascending base, high tide flag. I don't get into the discussion of all of that because all of that information is already given in MarketSmith chart. Okay. So we will not go there. We just know that it's a flat base and the high of this bar is the pivot point. Okay. Before this base, you see there is another cup with handle base here. This entire cup. Okay, if I don't know how to draw. Let me try. But if I draw like this, okay, this is a cup with handle. Okay, and then after this is another base, consolidation base. After which the stock broke out. Okay. So let me delete this. How to delete this? Let me check. Everything is deleted now. Okay. So there were two bases before this base. But remember, just because there is a base on the chart does not mean that you have to buy. You have to check the relative strength. You have to do liquidity analysis, comparative analysis, technical analysis, things like that. So if you check Sera Sanitary Ware chart on the weekly in MarketSmith, you will find that these bases, the relative strength was less than 80. And when the stock reached here, the relative strength started to get into the 80s. I think it was 81 or 85 at that time. Now, I have not checked the fundamentals of the company. I have not checked the market conditions at that time. I am just saying that assuming that you have filtered, shortlisted, and selected this stock, what would you do in such a situation? If you were presented with such a chart scenario, what would you do? That is the discussion that we are having here. In real world, you would do filtering, shortlisting, stock selection based on liquidity, comparative, technical, fundamental, and market analysis. Then you decide your position size, execute the trade, do the risk management using stop loss, and then manage the trade. Okay, that's the orange trading system in one simple line. Okay. Have a look at this base. How many red bars are there inside the base? 1, 2, 3, 4. How many low volume red bars are there inside the base? Out of 4, this bar and these two bars are low volume red bars. What is a red bar? A red bar is a lower weekly close compared to the previous week close. So if you have a red bar on low volume, what does that mean? That means institutions are not selling, right? If institutions were selling, the volume would have been higher. Now here you have below average volume, which means it is actually a sign of institutional accumulation. When the volume is low, it's the retail participants that are selling and institutional participants that are buying the stock. Okay. However, please pay close attention. What about this bar? This bar. Okay. High volume red bar means high volume, low close compared to the previous week. However, if you notice, this is a down closing week, but it is not a weak closing week. Let me repeat that statement. This is a down closing week because it's a red color compared to previous week. It has closed lower. Okay. Down closing week. However, it is not a weak closing week. Weak means if the closing was below the midpoint of this bar, that is called as a weak closing. But in this case, the closing is above the midpoint of that bar, which means actually there was actually buying in that week, more of buying and less of selling. Okay. So even this bar is a bullish bar, even though it has got high volume. So you understand there is a difference between up closing, down closing. There is a difference between strong closing, weak closing. Up closing and down closing is represented by the color. High, strong closing, weak closing is represented by the close of the bar relative to its midpoint. Okay. Continuing with our discussion inside the base, look at these two bars, very tight closing, very short spread. Spread means the distance between high and low. Tight price areas, short spread. Again, these two bars, tight price area, short, tight price area, but not short spread. But at least we have tight closings. Even these two bars, very tight closing. So one, two, three areas where the weekly closing was very tight, which means between one and the second week, the stock closed almost at the same point. Okay. That is a sign of institutional accumulation. Institutions would like to buy a stock when it is available cheap. They would not buy a stock when it is already extended. Okay. If they do that, they will end up paying a higher price, which nobody wants. Okay. Let's mark the pivot point. This is 6788, right? So let's do that. Hey, what happened here? So this is 6788. This is 6788 multiplied by 1.05, 7127. Let's give it blue color. That's our buying zone. Let's draw the selling zone. Green color. So this would be 6788 multiplied by 1.20, 8145, 8145, 6788 multiplied by 1.25, which is 8485, 8485. That's the selling zone. Let's draw the stop loss. 6788 multiplied by 0.92, 6244, and 6788 multiplied by 0.95, 6448. So the pivot point and the 5% range, that's the buying range. The stop loss is 5 to 8% from the pivot point below. The selling range is 20 to 25% above the pivot point. The pivot point is the high of this bar. It's very simple, nothing complicated. I have been doing this for so many videos in this video series, but I do it manually for you to help you understand how much time it takes, what I look at, and how I approach this. Okay, very nice setup here. The week's closing is between the pivot point and the blue line. That's very nice. Then very tight uh, price action inside the base, small spreads inside the base. The base is not too volatile. You see volatility here, very large spread. Here you don't see that much volatility. Plus the relative strength has also increased here. Okay. Most of the red volumes are low volume. Okay. Let's move it forward. Let's look at trade execution now. So the stock touched the pivot point, closed below the pivot point on Monday. Okay. Now Tuesday, see Tuesday it went into the buying zone. So out of 100 stocks, out of 100 shares that I would want to buy, I would buy probably 50 shares. Why? Why will I buy? Because you look at volume. What's the volume? 68,000 shares traded. between Monday and Tuesday, 68,000 shares traded, which means another 3 days to go. So if 68,000 shares are traded in 2 days, roughly 35,000 shares are trading per day. So 35,000 shares multiplied by 5 would be 175,000 shares to be traded in that week. What's the average? 96,000, which means just looking at the volume of Monday and Tuesday, you know that the week is going to close higher than that blue line, right? Just by looking at Monday's or Tuesday's volume, you can extrapolate. Just multiply it by 5, okay, per day volume. And you know the average volume is roughly 100,000 shares approximately. So you know that you are going to exceed the average weekly volume by 50%, 70, 75%, or maybe 100% more than average weekly volume. Okay, that's the 10-week moving average, by the way. So that is why you would buy. Okay, now after you buy, it comes down. That's fine. Okay, because you don't have control over the movement of stocks. You buy, you keep your stop loss at 8% below your average execution price. Okay. Thursday gone, Friday gone. Sorry. Yeah, that was Friday. So by the end of the week, the stock had already gone past uh, your buying zone, which means you also got the opportunity to buy the remaining 30 and 20 shares. So if I have to repeat that for you, so first click means Monday, you wouldn't buy anything because it never entered the blue zone. Tuesday, you would buy because it entered that pivot zone. You would buy 50 shares out of the 100 that you planned to buy. Okay, 100 or whatever number of shares, you just buy 50%. Then you go to Wednesday. Wednesday, nothing happened. So it closed below the pivot. So nothing to buy on Wednesday. Then Thursday, you would buy another 30 because the volume by Thursday has already crossed the average weekly volume. So you would buy another 30. So now out of 100, you have 80 shares. Okay. You still have to buy the remaining 20, which you can do on Friday. So during this day, when the price is trading inside this, the volume is going up rapidly. As you can see, the volume was just like maybe 10-20% above the, maybe 30% above the average weekly volume. But on Friday, suddenly it becomes twice of average weekly volume, correct? So you get the opportunity to buy the remaining 20 shares. So you've executed your trade. Basically, you accumulated all the shares. So this is a classic breakout, high volume breakout from a flat base. Let's see whether it reaches our green zone. Now we hold on. Now we don't do anything. In what case would you do something when the price is going up like this? See, you get an opportunity to sell. Probably here you would sell maybe 1/3 of your position, or maybe 2/3 or half of your position, depending on how much money you want to take out of the table, take off the table. Okay. Yeah. So there was your opportunity to sell some shares and keep the remaining shares as long as the price remains above the 10-week simple moving average. You would hold on to the remaining shares till the price closes below that 10-week simple moving average on high volume. If it closes on low volume, not much of a concern or not much of a worry. Now see what happens. I will move the weeks forward. It comes to test the 10-week simple moving average. Does it close below that? No. Now let's see what happens. Yeah, look at this bar. High volume, weak close. Is it up closing or down closing? It is down closing because it is a red bar. Down closing compared to previous week. Is it strong closing or weak closing? It is weak closing because the closing was below the midpoint of the bar. Is it high volume weak closing or low volume weak closing? High volume weak closing. Everything pointing towards uh, concern, right? So this is the bar when you would want to sell all your shares. Okay, it's anyways trading above the pivot. So the remaining shares you would want to sell. You wouldn't want to be in a stock that has closed on high volume in a particular week below that 10-week simple moving average. line. As simple as that. You will just offload your shares at no loss, no profit. You would come out at break even mostly. But you did get a chance to book some of your gains. That is why it's important to have that selling range. One of my subscribers had asked me, if the stock has got potential, why not keep 50% as the target? Well, I said you try keeping 50% target, but what if it starts to fall before reaching that 50%? So 20-25% is a very decent gain from a particular stock uh, in the stock market. It takes 1.5 years to get that 20-25% return, provided it's a good company. Here you are getting that same return in less than 4 weeks, right? So 1, 2, 3, 4 weeks you are getting 20% return. I mean, what else you want from the stock market? What are you expecting from the stock market? Okay. So that's a zone where you would want to do some partial selling, take some money off the table. And as per strict trade management rules, in this week you should be out. Whether you are out on Friday or whether you are out on Monday, Tuesday, doesn't matter. You could be out during the week also to further reduce your losses, because just like here we saw high volume up closing, here you will see high volume stock falling down sharply, right? So even on Monday, Tuesday, you will get a sense that this is going to be a high volume week closing week, or high volume down closing week. You can get a sense of the price movement, and you can start lightening up on your position. Then let's see what happens next. The stock comes back into your filter. So if you're scanning daily, that is why I told you, keep scanning daily on a day. Even if you're trading the weekly time frame, you have to keep scanning daily. So the stock bounced back. See, bounced back, closed at the 10-week simple moving average. Next week, it actually closed above. See, even though this was a weak closing bar, high volume weak closing bar, it was not a down closing bar, it was a up closing bar because of the color. And then it touches that 10-week simple moving average, continues to go up. By the way, there's another base here for you. After this, you have three consecutive bars which are below the high of this. So there's another base building for you. I think this was base number 2, 2C. This was base 2, base 2B, 2A, 2B, and 2C. I think that would be base number 3, right? Continues to go beyond. Now, some of you might want to hold on to some of your shares even on this week. Well, that would be very risky. And remember, in the previous video, I told you the true winners in the market rarely close below the pivot point. Remember how to make money in stocks, fourth edition, chapter number 11, page number 261. That statement written by William O'Neill. True winning stocks or true leaders rarely close below the pivot point. Has it closed below the pivot point? No. Has it been a winner? Yes. Look from where it went, from 6,700 to more than 9,500 rupees. Okay. In just a matter of few months. Okay. 4 5 months, 4 months roughly. That's a fantastic return. Okay. So you would probably want to buy back the shares that you sold here. You would probably want to buy back here. Okay. So, but anyways, that's pyramiding or scaling in, which we will discuss maybe sometime later. But I wanted to discuss this base with you because it was a high probability base. You got the opportunity to buy, you got the opportunity to sell, you got the opportunity to cut down on your position. The stock never closed below the pivot, continued to go up. You also got the opportunity to scale in or pyramid into the stock at the next base, that is base number 3. While this is going on, you have to keep an eye on market conditions. You have to keep an eye on quarterly earnings released by the company. You have to keep an eye on price and volume. So as a positional trader, you are not doing much. You are not doing much activity. You are doing a lot of mental activity. You are just observing things: price, volume, market condition, uh, the base count, things like that. Okay. I hope this video has been helpful. I think this was part number 30. And we will continue this video series because a lot of subscribers have told me uh, help shows a lot of examples of charts. Okay, so we will look at a lot of chart examples and what we should have done if we would have been there trading the weekly charts. Okay, thank you so much.